imagine how crowded your calendar and inbox are. So thanks for making the time for this. And now I'll turn it over to you to answer the question that we posed in the title, correction or crash.
Thanks, Prakash. It's so good to be with you. I really want to thank you for the opportunity. And it's my absolute favorite topic, housing and housing finance. It's good to see you. It's good to see Richard. Richard is a good friend, and
hello, Mark.
Him as well. And thank you for the 2 hours to speak. That was incredibly kind of you. No, I think I have about, how long do I have, Prakash? About 15 minutes?
Yeah.
15. Okay. Let's fire away then. So bottom line, I do think the U.S. housing market is going to experience a significant correction, but not a crash. And when I say correction, what I mean is kind of what's happening right now. Housing demand is falling. You saw yesterday's existing home sales numbers. We're down to almost 5 million units annualized. We were north of 6 million, closing in on 6.5 million not too long ago, beginning of the year. Home building is starting to weaken. If you listen, so far it's been more modest, but you can see it in the permits and the housing starts data, particularly for the single family part of the market. Multifamily is holding in better for obvious reasons. And house prices, there, I think it's going to take a little bit of time for the weakness to show up, the correction to show up. There was a lot of headlines yesterday around the median price from the realtors going up, but that is my read on that was it's simply a mix effect. As you know, it's affected by the mix of homes that are transacting, and the high end of the market is holding up better than the low end, and that biased up the measure. If you look at repeats, I'm sure once we see the repeat sales indices, it's going to show some weakness. And I do think the market is going to struggle here for the next year or two as it tries to digest the significant increase in mortgage rates. As you know, the 30-year fixed rate mortgage is doubled basically. You know, if you go back a year ago, we were well south of 3%. Now we're closing in on 6%, depending on the day. So that's a very large change in a very short period of time. And the correction is largely due to the higher rates, and it's exposing some significant imbalances in the housing market. If you turn to the next slide, the first slide in the deck, I think this kind of shows those imbalances very nicely. This is the percent of metropolitan areas across the country, and there are just over 400 MSAs, metropolitan statistical areas across the country, that have house prices based on our repeat sales index, the Moody's Analytics repeat sales index, overvalued by anywhere from 10 to 20%. It's the blue part of the bar, and those that are overvalued by more than 20%. And this is over time, going back to 2000. The last data point is for the first quarter of 2022. And you can see just how extraordinarily widespread across the country the overvaluation is. This is measured by taking the percentage difference between the actual house price in these markets and the estimated fair value price based on a model of house prices that we use for forecasting and scenario analysis. And the model is a error correction model with an equilibrium equation or trend equation, and that's driven by incomes, household incomes, and construction costs. So at the end of the day, a home's value is the sum of the value of the land, which is ultimately tied back to GDP and incomes, and the cost of the structure, which is tied back to construction costs. Now that varies quite a bit across the country. So if you go to San Francisco, for example, the value of that structure, the value of the home is mostly the value of the land. The structure is not really that important. But if you go to a place like, let's say, Pittsburgh, it's the opposite. Construction costs matter a lot more. So we account for that in our modeling, and based on that, we calculate what's shown here. And you can see over 80% of metro areas are meaningfully overvalued by that measure. They're very stretched, and so that you can live with that when interest rates are abnormally low, when the Fed's got interest rates at zero and is quantitative easing and buying mortgage securities and getting mortgage rates down. But that doesn't work in a world where interest rates are more normalized and fixed mortgage rates are back to 6%. Just as a quick sidebar, in my view, in the long run, in equilibrium, economy at full employment, inflation at target, growing at potential, the 30-year fixed rate loan should be somewhere between 5.5% or 6%. So that would be like a 4% 10-year yield plus a 150 to 200 basis point spread, and that gets you to 5.5 or 6. So basically, mortgage rates are back to where they need to be in a long run equilibrium sense, and thus close to fair value. Of course, a corollary to all this, and you can go to the next slide, is just more clearly is that affordability has been hammered by the increase in mortgage rates. You mix these now very high house prices with these much higher mortgage rates, and housing is just not affordable. And you get a really clear sense of that here. Just a simple calculation of taking the median price, assuming a 20% down payment, looking at the mortgage rate, calculating the monthly payment, comparing that to the median household income. And the last column shows the mortgage payment as a percent of income. You can see at the current 5.7% fixed mortgage rate, that I think that's from Freddie Mac most recently, 35% of the median household income is is paying on the mortgage, and that's with the 20% down payment. And you can see how that compares to other points in time historically in today's dollars, and you can see just how high the payment is. So this really strikes home the point that first-time home buyers are locked out. They just simply can't afford to buy, and thus the collapse in sales. And I think trade-up buyers, they're locked in. The average coupon on outstanding mortgage is 3.5% to 4%. And if they sell and buy, they got to get a new mortgage at 6%. The increase in their monthly payment is too much to bear. And so you'll see some trade-up buying, but a lot of it will be curtailed. So home sales have really gotten completely hammered here. Inventories are rising across the country. They're still low by historical standards, but I suspect that's going to change pretty quickly, particularly in the most juice markets. We're seeing really large increases in inventory, and I think that suggests very strongly that we're going to see some correction in price here. The market is going to correct. I don't think it's going to crash for several reasons. First and foremost, you can go to the next slide. The housing market is very tight. The availability of homes for sale and rent is very low by any historical standard, and that's what I'm showing you here. This is the vacancy rate across the stock of homes for sale and rent, and go back to 1965, and you can see how dramatically the vacancy rate has declined, and not quite at record lows, but pretty close, and a very significant kind of picture from the right before the housing crash a little over a decade ago. That was a crash, and that was due to a lot of factors, including a significant oversupply of housing. We just don't have that today, and this undersupply, this shortage of homes, particularly in the affordable part of the market, you can see is only going to get worse in the current environment. By the back of the envelope calculation in the northwest part of the chart, that shows current housing supply. It's running at about 1.7 million homes annualized. You can see the breakdown: 1.1 million single family, multifamily. Multifamily is actually high by historical standards and will continue to rise given the shift over to rental, because first-time buyers are getting locked out of the single-family market. But single-family is obviously very depressed. Manufactured housing won't add up to 1.7 million, but underlying demand for the moment, 1.8 million units. You can see how I get there: formations, obsolescence, second homes. Although I suspect we're starting to see some demand destruction here. I expect household formation to really start to tail off because people just can't. You're going to see first-time home buyers continue to rent. You're going to see a lot of people just not form households because they can't afford the rent. And we'll see a lot fewer household formations, here in the very near future. But this is a very striking difference between today and the housing crash, which was a crash. Prices were down, depending on the index, 20 to 30% from peak to trough. Peak was 06, 07. The trough was 2011. Very different kind of environment. Second big difference is the underwriting environment. I should disclose that I'm on the board of directors of MGIC, one of the nation's large mortgage insurers, and I'm the head of the risk committee. So I spend a lot of time looking at underwriting conditions, and they're good. I mean, there's been some erosion recently along debt to income ratios, as one could imagine, given affordability. But in the grand scheme of things, pretty small, and there's very little so-called risk layering going on. Layering of different credit characteristics, DTI, LTV, credit score. If you go back prior to the financial crisis, the risk layering was very, very significant. It's very minor today. The other thing is, big difference between today and in the financial crisis when we suffered a crash was just the mortgage products. The vast majority of products today are, because of QM rules and changes under regulation, they're 30-year fixed, 15-year fixed. Back before the crash 10 years ago, a little over 10 years ago, you had all kinds of wacko mortgage products, 2-year subprime arms, neg am loans, all kinds of things going on. So very, very different kind of credit environment. And then third, and you can go to the next slide, is you just don't see the kind of speculation in the market that you did back prior to the financial crisis and the crash. That's shown here. The green bar left-hand scale is the number of estimated flips based on transactions. We look at when a home is purchased and then when it's sold. And if it's purchased and sold within 1 year, we define that as a flip. These are speculators, people looking for a quick buck. And you can see that the levels have started to push up here. No surprise, given particularly in the juice markets in the South and the West, but on a percentage basis, they're still quite low, and much lower than they were prior to the financial crisis and that crash. There are some markets where flipping is more elevated, and we need to watch that, particularly in the Southeast and in the West. So poster child would be Charlotte, North Carolina, maybe a Tampa, Florida, Phoenix, Arizona, Vegas, but there's a handful of them where I think this is a real threat. The other thing I'd point out is you've also seen a very significant increase in demand from low levels, but still an increase in demand from more institutional investors that are buy to rent. And while I think they've gone to the sidelines here to see if prices don't come down, they're not sellers. This is a long-term business model, and I think that puts a proverbial floor under price and makes it much less likely to experience a crash. So you sum it all up, and you go to my last slide, which is kind of the bottom line in terms of forecast. And you can see on the left-hand side, that's the outlook for house price growth. You can see history and the forecast under different. Here in the baseline is the blue line. Basically, I'm expecting national house prices to flatline here over the next few years, maybe a small decline by this time next year. But you can see that is the baseline, current mortgage rates, the peak. We avoid a outright economic recession. It's a pretty sanguine economic outlook. And then I show several downside scenarios at different points in the distribution of possible outcomes. So that green line represents kind of like a CCAR-like stress test where you're way out on the tail, 4% probability that it will happen. But that's more like a crash. So you do get that would be a peak to trough decline in that scenario of about 20%, which anything over 10% peak to trough I would characterize as a crash on a nominal basis. So if we do suffer a recession, particularly a severe downturn, obviously crash becomes more likely. But in a more likely scenario where the growth weakens, unemployment may notch higher but doesn't rise significantly. I don't think national house prices will decline in a meaningful way. But there will be some price declines across the country, and that's the point of the last slide on the right. That's the 400 metropolitan areas again. And those areas that are in red or orange will experience price declines. Those in red, meaningful price declines over the next couple of years. The worst price declines are in those most used markets are close to double digit, kind of 10% peak to trough, like a Phoenix or Tampa. Although in the grand scheme of things, those are markets where prices were up 30% this past year and 30% the previous year. So you're only giving back a bit of what's been gained over the past few years. So with that, I will stop. I took my 15 minutes, I think, on the nose. I could have spoken for 2 hours, but I didn't think you'd like that too much. So I'll turn it back to you.
Great. Thank you very much, Mark. As always, your comments are comprehensive and insightful. I couldn't help but notice those red marks on your last chart about affordability correlated pretty well with high climate risk, which is an issue that I think is worth bringing up here at some point. But I'll just start with the bulk of your presentation. Your comments on a modest correction, continued problems with affordability, I think ring largely true. I can quibble a bit around the edges, but I think what would be most useful here is to get a little bit of details about your thinking in this regard, both from the perspective of U.S. housing policy, which is quite active area at the moment, and also some of the questions about capital markets developments and how things are changing in light of the higher interest rates. So with regards to policy, affordability has not escaped, or the lack thereof has not escaped the attention of the regulators, notably with regards to first-time home buyers. As a result, there is a lot of talk about fee cuts on the part of the agencies. For Fannie and Freddie, we're talking about their G fees and the LLPAs. Those are specified fees that maybe there will be some changes directed exactly at first-time home buyers, and at FHA for their mortgage insurance premium for the MIP. Do you think these changes are likely? Do you think they'll be effective? And do you think they'll help prop up demand in a difficult rate environment?
Richard, I think the probabilities of cuts in the FHA premium are higher than cuts in the Fannie Freddie G fee. I mean, you can make a case that FHA is doing very well financially, at least by the standards of FHA. The MMIF fund is in pretty good shape, and it has been for quite some time. We've kind of gotten to the other side of the pandemic and have a clear vision of what the credit problems are. So I think you can make a case for a 25 basis point perhaps cut in the FHA premium. I say even odds though, because I think it has budget implications that I'm not sure the administration has budgeted for, and I'm not sure they can actually do it without accounting for that in some way. I'm not sure if that might be some kind of constraint on their ability to execute on that. Fannie and Freddie less. I think the probabilities are lower, and there I'm not even sure it's meaningful. We're talking basis points. We're not talking 25 basis points. We're talking basis points. So I'm not sure. It's kind of spitting in the wind. At the bond market, the mortgage rates move that. And take a look. They're moving like that in 1 minute. They move that much. So I'm not really sure that's going to make a big difference there. I think that if the policymakers really want to have an impact here, and I don't think there's much they can do immediately, but if they want to have an impact, they got to really focus on the supply side of this market. And if I were them, I'd be focused on tax policy, because you could, juice up LIHTC, that's the low income housing tax credit, which is key to the affordable rental market, or new market tax credits. I think I'm also the lead director of a large CDFI, and we love new market tax credits. So, good to know that I'm coming from that perspective. Or the new neighborhood home tax credit. The FHA director, Julia Gordon, pioneered that pretty cool idea, and that might have some political traction. Republican Democrats tend to like, because the Democrats view it as a tax expenditure, Republicans view it as a tax cut. Maybe you get something through, and that could have an impact, within a year. And there's other things that can be done, but it will take a longer time to have any effect. But I don't know that premium cuts by FHA, Fannie and Freddie are kind of, going to make probabilities are about no more than even. And even if they do happen, I'm not sure that's going to change the dial here to a significant degree.
Right. I think in Fannie and Freddie's case, there's been more conversation about targeted cuts, like towards
Yeah.
first-time home buyers, right? And the same point applies about how much will it have to do, but there's also the element that they, would be looking like they're actually, responding in some sense, given, the constraints and what else they can do in a short period of time, right? So, I guess I think there's more of a chance that something will happen, but I don't disagree about how big an impact that will have. Along the same lines, and this is a little further afield, but there is all the concern in the housing policy space about inclusiveness and as far as it affects affordability, right? There have been programs for decades aimed at lower income and minority borrowers, but the situation in terms of their home ownership rates haven't really bridged the gap with the white population in any significant way since the Fair Housing Act was passed in the 1960s. Fannie and Freddie now have these programs that have been mandated by FHA, the Equitable Housing Finance Plans, which are designed to help underserved consumers attain and sustain home ownership. Fannie and Freddie just last month issued their reports on their plans for the next 3 years. So it's kind of a similar question. Do you think that these plans can have an impact on this important social issue? Do you think they can support the overall level of demand in the rate environment, or is that also not realistic to a very large degree?
Well, I mean, I think it's laudable that the FHFA now the GSEs are thinking along these lines and looking at this through a prism of inclusiveness. They always have, but I think they're doubling down, and I think it is obviously very important and useful that they experiment in different ways, and that I think is the intent of these special credit facilities, that they're vehicles that they're setting up to try to execute on these different ideas. So I think those are all good, but that's a long-term kind of development. I don't think it is. These are pilots. I don't know how easy or hard it's going to be to scale to really make a difference. So
Right.
here more broadly, this is I think an important point. I don't think we need. I think it's much more important that policymakers focus on the supply side of this market than the demand side of this market. The problem is supply. We need supply. And we've got a lot of restrictions on supply, some of which are long in the making, like what's going on with zoning and permitting. Some are more recent with the pandemic and the impact on supply chains and labor markets. And foreign immigration has been constrained, and a lot of those workers work in the construction trades in those parts of the country where we need a lot more supply. So if I, were king for the day, I'd be focused like on the laser beam on the supply side of this market. That's why I talked about those tax credits. I brought that up first because those are things that politically maybe, because you need legislation to really move the dial, and then start moving to thinking about things where you have actual outlays and expenditures. If you go back to the Build Back Better agenda that President Biden put forward, part of that was housing supply. It had, as I recall, 150 billion over 10 years in housing supply, both tax credits and expenditures appropriations. And I thought, that's a pretty good way to go here to try to address the supply side issues. And then, you got to start working on, and they had some creative they put out a white paper. The administration put out a white paper on this issue maybe a month ago now, where they did identify some carrots and sticks they're trying to use to get local governments to relax some of their restrictive zoning rules and permitting costs that make it very, very difficult to, increase supply in communities where it's obviously very needed, particularly for for underserved communities. But I would say this is a big deal because, home ownership, it's gone up, it's gone down, it's gone all around, but it's gone nowhere in 2 generations. And you're right. The white home ownership rate is, I'm making up the number, but it's close, 75%. The black home ownership rate is 45%. The Hispanic is 50%, and that's not going to change. And with demographics, the demographic trends that are underway, the aggregate home ownership rate, just simply take demographic shares, multiply by their current home ownership rate, it's going to fall. It's going to fall quite significantly. So we have to get a lot more creative on how to address this. By the way, this is an advertisement. I just wrote a paper with Mike Stegman and Jeb Mason on lease to purchase. So this is an idea to help take people from renters into homeowners and try to facilitate that process to address this question about how do we become more innovative in trying to figure out ways to get the minority groups, lower income households into home ownership. And it was just released this week, and people might find that of some value.
Yeah, that's great. I guess my personal concern is that these supply issues will themselves take a while, and that even though demand's suffering, it may not be enough to get you the kind of price adjustments that you need to alleviate some of the problems in the markets. And a growing use of arms, for example, is another aspect of that. But I don't want to keep going on. We have a couple of folks from the fund here who have some questions. Nina Biljanovska from the research department. Do you have a question or two for Mark?
Thank you, Mark, and thank you, Richard. So those were very important questions that you were raising on affordability, and we have been also working on affordability, but cross country. So very important topic, definitely. So I was thinking something along different lines than the questions of Richard, which is more like in terms of the comparison with the GFC. So we know that the current housing boom is characterized by much stronger balance sheets of both households and banks. So for example, household debt is not that high, at least in the US. Banks are well capitalized, lending standards are high, loans are issued to less risky borrowers, as you alluded to. So my question is like, if there is a correction, and as you mentioned, it's likely to be mild, but what are the risks that we should be watching after? What segments seem most vulnerable to you, and who and what is most likely to be affected?
So what you're asking, what indicators should I be watching to gauge whether the housing market or the economy is going in a negative direction?
So no, I think the question is more general, not very specific, like in terms of what sector, but we know that potentially there is a correction, and as you mentioned, it's going to be mild.
Yeah.
Like households are not very much indebted. I mean, that is like their fundamentals look strong, and also banks look well capitalized. So what are the risks that we should be watching from? So what is in your view?
I see.
Yeah, potentially, yeah.
So from a broader macro sense, what fault lines in the economy or financial system should I be focused on to exacerbate any kind of weakness or downturn that we are going to suffer?
Correct. Yes, and I think, I mean, based on your presentation, it seems like that there are like some areas that are overheating. So I don't know if like maybe specific segments, is it location, is it I don't know, specific sectors, specific segment of households that we should be concerned about. So because it's not trivial this time around. I mean, even if there is a correction, somebody will be affected by that. So my question is like, in your experience and by looking at the data so far, who do you think will be most vulnerable from a correction outcome?
Yeah, I don't think that I'd look to the housing market as that macroeconomic threat. there's the underwriting has been very good. The mortgage products have been pristine. Of course, the banking system has been put on very solid ground. I don't see, even in a 10% price decline scenario, significant increases in default, foreclosure, and distressed sale. And that's what you really need this thing to become a bigger problem for the issues in the housing market to reverberate back and cause bigger problems for the financial system and the real economy. So and generally the thing that does an economy in the last time isn't the thing that's going to do the economy the next time, because of all the reforms and changes and the memories. A lot of the people who are still managing companies in this space and regulators, they remember 10 years ago. It's just not that's not where the problem's going to come from, I don't think. And broadly speaking, I feel pretty good about the balance sheet of the US economy, and why it's one reason why I think we can avoid a recession. And if we do go into recession, why it will be relatively modest. There are a few stress points. If I were looking on the consumer side, I'd be focused on the auto lending market. I mean, that's, there's the old adage in banking: if it's growing like a weed, it's probably a weed. And that would apply to, auto lending, particularly, some lower quality auto lending. But even there, used vehicle prices have gone skyward. So there's a lot of equity built in. So people can go delinquent, but they're not going to default and get repossessed on. So I think, even there, the risk is relatively low. On the corporate side, I do worry leverage loans, although I've been perennially worried about leverage lending just because of the growth rates. But, there are, I think, in a rising rate environment, there's potentially more stress there. So in the distribution of that debt is very barbelled. You got some folks that are in pretty good shape, some that aren't. So I think I'd focus there as well. But in broadly speaking, I feel pretty good. The only thing I'd call out where I would be focused or paying some attention to would be kind of the non-bank, part of the system. There, it's more about liquidity that could turn into a solvency issue, and the non-banks do play an awfully large role in the mortgage space. And actually, the Fed and the OFR and FSOC have done a pretty good job of shining a light on that. And I think we have a better grip on what's going on there. But nonetheless, if I had to pick something that I'd be focused on, that might be a stress point that could rock the system or the economy more broadly, it'd probably be the non-banks in the mortgage space where I'd be more focused.
Yeah.
Okay.
That's
I'm sorry, Nina. Do you have a follow-up?
Yeah, I have a follow-up question, not follow-up question, but actually another question in case there is time. So Prakash, please advise.
I think maybe we save that for when Denise comes on, and maybe turn to Adrian. I think he had some questions.
Yeah, Adrian, why don't you, Adrian Alter from the fund?
Thank you, Richard. Thank you, Prakash. And thank you, Mark, for the presentation. It was very interesting to see. It reminded me a bit of some work in the GFSR we've done some time ago on house prices at risk. Yeah, so my questions are related a bit to some of this demand that you have mentioned in your presentation. So you mentioned the flippers. Perhaps during the pandemic, we have seen also second home buyers in cash. You also mentioned the institutional presence in the residential housing market. Those e-buyers or iBuyers that started to purchase big quantities like Zillow and others, and then started to sell that based on their models. So I was wondering to what extent some of these non-traditional buyers are sensitive to interest rate changes, and whether some of them will come up in case of a downturn and prop up prices.
Yeah, I'm generally sanguine is the word, I think, with regard to investors and the housing market. In part because, as I showed, the flipper share, which they're short-term investors, is a very small part of the market and has remained so. Second, the kind of longer term institutional investor, I think I might have mentioned this in my presentation. I don't think they're going to sell. They will stop. They've already stopped buying. You know, if you talk to them, they've stopped buying because they believe that they can get a better price 6-12 months from now. And they're in those markets where I think prices are going to decline. So that's probably, you know, a wise kind of investment strategy. But these are long-term durable business models. They've raised a lot of capital, and I think there's a lot of room to run here for them, unless they get derailed by policy in some way. But that I have a hard time figuring out how that would happen. So I think they're not going to sell. So I view them as, you know, contributing to the recent decline in home sales, but I find them as a more durable, you know, source of support to the market. And they'll come in when they sense that opportunity, when prices are down 5, 10, 15% in Phoenix or in Jacksonville. The second home buyer, I think, you know, there's going to be some weakness there, but I think generally these are high income, high net worth households, a lot of foreign buyers that have a lot of financial resource. You know, yes, the stock market is down. Yes, crypto is down, and that will take some of the steam out of that second vacation home market. But there's, you know, I think there's plenty of wealth there and plenty of demand. And I don't view that as these folks are going to be big sellers. And I think there's probably some pent up demand there, actually. I can sense that people are waiting for opportunity because prices have gone skyward in these second vacation home markets. So I generally view what's going on with the investor demand as neutral to positive to the housing market. I don't view it in the context of the correction that we're experiencing and will experience over the next couple of 3 years. I will say one other thing, though. Institutional investors are going to be a problem, back to my point about home ownership. Another reason why home ownership is going to decline is because institutional investors are going to become owners. That is a good business model. And, you know, if you go to the multifamily market, that's already been institutionalized. They have now figured out how to institutionalize the single family market. They got scale. They've got a structured finance market that's operating. They got capital, you know, from multiple sources. This is a real business model that has legs. So I think the single family market is going to continue to be institutionalized. And again, those institutional investors are only a few percentage point of the market. They got a national market that bigger in some parts of the country, but that they have a long way to run. And that's going to be another downward pressure on home ownership, and another reason why we have to focus on supply, because unless we get more supply and rent growth and house price growth remains strong, that's just going to make it even more attractive for those institutional investors to continue to pursue that business model, and to the detriment of home ownership.
That's absolutely a great point, and part of the concerns that I was expressing about there's still a lot of sources of demand. But in any event, thank you, Mark. I'm not sure if you can stick around.
Oh yeah, absolutely. I wouldn't miss
longer. Please do. But I want to invite Julia Coronado to join the conversation.
I'm going to heckle Julia. I'm just saying. I'm going to heckle.
Now the hard questions are going to come. But Julia, for those who don't know, is the founder and president of Macropolicy Perspectives, which I would argue is the leading source of expertise on what's going on in the economy and its impact, in particular on monetary policy. So really delighted that you could be here. Julia, you've heard all this, had a chance to absorb it. I think it'd just be great to hear your perspectives, but in particular, what does all this mean for the Fed? We're expecting another big rate hike pretty soon. Does this encourage that view? Does it mean they're going to be more cautious? Does it not have any impact on their likely policy at all? I'll be delighted to get your feedback on that.
Yeah, so I think that there's a really interesting, I'm pretty sympathetic to a lot of the fundamental structure of the housing market that Mark laid out, and sort of the strength of the fundamental underpinnings, the differences in terms of the consumer exposure and indebtedness, and the institutional layering. I do wonder, though, you know, we've had one of the important sources of inflation has been asset price inflation, and housing has been right alongside all the other asset price inflation. And so, I'm curious about like the distinction between, a correction and a crash. I kind of think of housing and the investor dynamic this time as, a bit more akin to the late 90s and the tech bubble than the housing bubble per se. In other words, you have these investors, they've got this business model, and I agree, Mark, it's a real business model. It started after the housing crash. It's a source of rental yield for institutional investors. It's a real thing. But, at what price, right? They were such a source of speculative momentum in the hot housing markets. And I'm living in Austin, Texas right now. So I've been watching all of this on the way up and now on the way down. So yes, I agree it's a durable business model, but, you could also still see pretty big price declines just because there was so much speculative, momentum and liquidity going into this, and it can just correct hard on the way out, like a NASDAQ boom bust, which also, the NASDAQ, obviously there was a real element, a real business model there, but a layer of speculation was added on top of it that got squeezed out, and then we moved on. So I think we could see I personally think we could see a bigger decline in prices without necessarily that kind of, ripple effect or debt deleveraging dynamic like we saw in 2008 and 9. And I'd love to hear your thoughts on that. What it means for the Fed, I think actually, it could be a positive for the economy if we got a bigger correction in home prices. It would be, it would ripple into rents. Rents has been a big source of inflation, in consumer price inflation. If we got a correction in home prices and a correction in rents, or at least rent growth, that could actually provide some relief that would allow the Fed to hammer the economy less. So I think, we all know, for those of us deep in the weeds of this kind of transmission from home prices to rents to consumer price inflation, there's these long lags. But the leading indicators of home prices and these market measures of rents, if those start moving down more noticeably, then that could be, something that the Fed can lean on to say, okay, we don't necessarily need to go as far. So, I mean, right now it's going the other direction. Right now we've got home prices that, we know the high frequency measures have started to show signs of price sensitivity and discounting. That's only going to flow through to the official measures with a lag. And then an even longer lag to rents and CPI. So right now it's adding to the Fed's hawkishness. So they're in a bind. I think that the multiple sources of inflation, including the way this asset price inflation has contributed to consumer price inflation, makes their choice set very difficult. And right now they've been, they've shifted into the territory of we can't look at nuance. We can't fine tune. We've just got to crush this dynamic before it spreads and deepens even further. So in some senses, I think the faster the housing market can correct, the better for the prospects of a soft landing. In some senses, a hard landing in home prices could not necessarily do that much damage to consumers because they haven't leveraged into it. It hasn't been primarily driven by consumers. It's been primarily driven by investors. And so if investors take some losses or have to adjust, their return expectations, that I think that's that the economy can absorb that a lot better than what that similar home price decline would have done in 2009, 10, when consumers were leveraged into it. So, I mean, at least what I'm seeing in a very speculative market here on the ground in Austin is a rapid pace of price discounting is taking hold, which I think is great. I actually think, you know, we've gone up about 50%, you know, one of the highest paces of appreciation over the last 2 years. And if we went down 30%, it would be fine. You know, you'd still have most homeowners up in value, and meanwhile, it could provide a lot of relief on rent growth, on affordability, and facilitate a move back to lower mortgage rates over time.
Very interesting perspective. Thanks a lot.
Rooting for a home price crash.
Yeah, right. Well, there we go. There's certainly a headline in there somewhere. But one of the other issues with monetary policy has been you know, the unconventional policy, the asset purchases. Do you see this? I mean, 6 months ago, there seemed to be a greater sense in some of the comments I read from the Fed about leaning more on the asset side, possibly including sales. That seems to have died down lately. This is a casual observation. How do you see this playing out between rates and asset purchases?
Yeah, so there was that dynamic. It was something that's definitely played a role in mortgage spread widening and the much more rapid rise in mortgage rates than in treasury yields. So, you know, I know this, you know this, Richard, from working in this space, that the threat that the Fed was holding over the market to possibly sell mortgages. And again, the rationale is there's a certain segment of the Federal Open Market Committee that views the mortgage buying as a form of credit allocation, that they, all else equal, would like to get their balance sheet to a treasury dominated balance sheet and get rid of the mortgages as fast as possible. And we also know that because mortgage rates were so low, these mortgages were issued at such low rates and mortgage rates are so much higher, that prepayment speeds are going to be very slow. So the pace at which the Fed can allow its balance sheet to its mortgage holdings to just passively roll off is going to be extremely slow. And in fact, you know, they've announced these caps, and that they're going to fill the roll off. The caps are the caps on the monthly pace of reduction in their balance sheet. They have a cap on treasuries, a cap on mortgages. They can fill the cap on treasuries with, you know, short end treasuries, with bills. And so they're going to get that roll off as much as they're going to roll off right up to the cap. On the mortgage side, they won't.
That's right.
Because it's going to be very slow. So that led to that group on the Fed to, they're not happy about that. So they want to think about selling mortgages. I think events overtook them in the sense, like, as you noted, they've had to speed up on rate hikes because the inflation dynamic has been so rapid and so broad-based, and there's some substitution between these two tools. Yes. You know, the original plan was, we're going to go up on rates in this kind of steady fashion, and then we're going to go, you know, we're going to take down the balance sheet in this steady fashion, and then at some point we might, you know, sell mortgages. Now they're just leaning hard on short-term rates, and it's doing a lot of work. And they've said that that's the marginal tool of policy. So at the margin, they've had to go hawkish and tighter. They're doing it with short-term rates. And that suggests, all else equal, that they're less likely to sell mortgages down the road, because we're going to get some kind of a landing, whether it's hard or it's soft. It's going to come sooner rather than later. And it'll come from their raising of interest rates. In my view, the likelihood that they would actually contemplate selling mortgages has gone down because they're leaning so hard on short-term rates. So we've adjusted our own forecast that way. More rates and actually ending balance sheet roll off at some point next year, because the economy is going to be, in a much more low demand state, close to or in a recession than we had thought before they accelerated the rate hike cycle. So I think there's less likelihood. I don't know that the mortgage market has taken much consolation from this yet.
Right. No, there's any number of other issues, but I think, yeah, that fits with my perception about how the commentary has gone. I mean, the Fed's, this is still a relatively new tool, right? You don't
Yes.
have the decades of experience of what does some action mean. You've had these hiccups like the taper tantrum that unsettled the markets on the back of a single word, right? So they're trying to get to that. But the thing to remember is the mortgage market has always had some support. And prior to
Yes.
the financial crisis, it was the GSEs. They
Right.
maintained these giant portfolios that they could increase and stabilize things. They're out of that business now, and the only player in town is the Fed. So
Yeah.
whatever
And
they
now
do,
the Fed is out, and so
they-
the mortgage market is really flying without a net for the first time.
that's exactly right. So
Yeah. Yeah.
the Fed's figuring out what its role is in that, and it'll be interesting to watch. But
It will be
anyway,
interesting
I
to
think,
watch.
am I right? We are just about on target here. Prakash, hand it
thanks
back
very
to you.
much.
Bring Denise in, I guess.
Yeah, I'll bring in Denise. I just wanted, Mark, do you have a quick 1 minute comment on Julia's feeling that this is more like the tech bubble?
Well, I don't want to disagree with Julia, because that's always a mistake. Always a mistake. I will definitely be wrong. I'll just make one point. The housing market is very different than the equity market, in that sellers are very reluctant to sell if they can't get the price that they think is the appropriate price. And for most people, the appropriate price is the highest Zillow price they ever saw. That is what my home is worth. I'm not giving up on that. So what happens is transactions will get crushed. The shadow price will
Yeah.
be consistent with the decline in equity prices, but the actual price that shows up in the price indices probably will not be. So it's a very different kind of dynamic, I think, and therefore a big difference between equity and housing market, particularly in the current context.
Fair
Okay,
point.
well, I think it's definitely a conversation to be continued. Mark, I'm hoping that you're right, that it's just a correction, because just an hour ago, I found out that my son bought a house in Fairfax, Virginia.
Oh, no.
He may have bought it, but
Isn't he listening to you,
he was
Prakash?
so keen to get out of our house that he didn't care. So anyway, so let's turn now to our not old, but dear friend and colleague, not old at all, Denise Igan. So Denise, as most of you will know, was at the IMF and now is at the BIS. And when she was at the fund, she was one of our most prescient commentators on housing markets. I remember her kind of calling corrections in a number of markets, Netherlands, Dubai, etc. And Denise is here today to expand the conversation a bit beyond the US market, as we've been doing so far. Tell us a bit about what's going on in other advanced economy markets, and also reflect a bit on how the pandemic may have changed housing demand, housing markets in a fundamental way, which I think will address a question I think that Nina had wanted to ask about, some of the longer term structural changes that can influence the current conjuncture. So with that, over to you, Denise, and sorry that you had to stay up so late to participate.
No, it's always a pleasure, Prakash. Thank you, and thanks to everyone, Richard, Mark, Julia. It's great to hear those views as well. So in the interest of time, I'm going to jump right in. Of course, the views are mine. compiled with my colleagues Emmanuel Kolshin and Furchai Sharan Kitkul, and not the BIS. But what I want to show you is, if you remember one picture of my presentation today, is this is showing you basically the comparison of housing market, house price developments in a range of advanced economies in past recessions from 1990 to 2019, and what has happened during COVID. And I think it's a very, very striking pattern to see in terms of, in the past, we were used to, whether it was started by housing market or not, we would see house prices dip and then slowly recover, perhaps around, nominal prices would dip around a quarter later, and then we would start seeing the recovery. Sometimes real house prices just stayed stagnant a bit more, but this time around we didn't see any dip at all. Prices just kept on going and going, and this is not only for the US. Mark talked about it, but this is happening in other advanced economies as well. Not as much on emerging markets, but in many advanced economies that we have data on, we're seeing this pattern. And then the other thing to notice, of course, is that the dotted lines, when you look at the blue and red, nominal and real, they started diverging, and that's showing you the peak of inflation, what's going on there. The other interesting thing is when you turn to the mortgage side, the credit side of housing, again, very different pattern from what we have seen in the past, where we used to have household credit growing at a rapid pace, and then it would start slowing down. And once the downturn came, we would have households deleverage, and household credit growth staying low for quite a while, and rates would go down, they will stay low for quite a while. This time around, this is not what we have seen. We haven't seen the type of twin booms where house prices would go up and credit would go up. This has not happened. We had quite 1.5% growth in household credit prior. You see the hump after the downturn, actually, that's related to the policy measures that were taken. And now only recently we're seeing some weakening of household credit growth, which is related to, of course, the red line going up, interest rates, as Mark mentioned, starting to come up. Now, what I would like to talk about next is how do we explain this very distinct pattern from the past. And one thing, of course, is financial conditions. And what I mean here is not only the credit, we talked about it there, it was not a credit-driven boom, but it is important to recognize that economic activity, thanks to all the unprecedented, monetary and fiscal measures that were taken, it recovered much faster than many of us thought. And the exceptionally easy financing conditions boosted demand. It also compounded with the healthy balance sheets of households and their high, liquidity positions. And nowadays, before when we first started thinking about these issues a year ago, if a household was looking to be an owner occupier, they could borrow at historically low levels. And actually, even today, at 5-6%, this is still quite low, right? So when you think about it, if somebody is set to, household formation age, they have a preference for being an owner, then it still makes sense. And this is what this is again very common across countries. What we're looked at is the common factor across advanced economies in terms of explaining the house prices. And you can see the blue bars are what we used to see until 2015, and then the red bars, you see in many of these countries, it started increasing. So now 60%, about 60% of the house price movements we're seeing are attributable to a global common factor, which is not surprising again. Pandemic was common. It was global in nature, and many of the policy responses were also common. So what has happened then was we have seen this increase in the portion of house price movements that are explained by a common factor. And you can also see this, the commonality of interest rates and their impact. What it started driving is a search for yield. And what we did was compare the rental yields you would get in different cities across the world to the bond yields you would get if you were to, you had some money that you're sitting on, and you can either buy a place and rent it, or you can invest in a 10-year sovereign bond. And as you can see, in all of the countries that we looked at, rental yields far exceed the bond yields. Of course, things started moving, but the yield is there. And with that search for yield, we did see this strong demand and also the investor part that Mark talked about. On the institutional investor point, perhaps one thing to note, we did look at across countries, and in some of them, like the UK and Australia, you do see a pickup in the investor share or the institutional buyer share, but we didn't think that it was as common. So many of the small advanced economies, it's actually households, not as much the institutional investors that are coming in. And one last thing to perhaps note on the financial side is that with inflation now picking up, in many cases, households tend to see real estate as an inflation hedging device. So we may actually see continued demand, and I think that's something that could keep that idea going, also with what's happening in equity markets. Now, turning to the, I see Enrique, I think something might have happened with my sharing here. Doesn't look like I'm able to move my slide, but okay, now we go. Now, financial side, okay, well taken. But the other thing that happened is that during the pandemic, and we talked about this in early presentations as well, some of you are familiar with, the demand for space increased. Right, it's not like you are, all of us went through that. You used to have this little desk at the corner. That's not enough. You need a real home office. And this is not only about, needing more space and moving from the urban areas to elsewhere, but you need to also think about, for example, younger professionals sharing an apartment with their roommates and whatnot, and realizing that everybody needs their corner and looking for moving and having their own space. So we see that, again, it's not only a US phenomenon, which has been documented by several very, very good papers, but this is happening elsewhere as well. And when you look at the slide on the graph on the left-hand side, you see pretty much, except for, I would say, Japan and Germany, the yellow bars are exceeding the gray bars, and the yellow bars are for houses, the price increase you observed for houses, versus the gray bar is for apartments. And the other chart is showing in the US context, when you look at the three major cities, Washington, Boston, and LA, the commute time used to be, in 2015, the farther away you got from the city center, the less you would pay. But during the pandemic, that got reversed. So actually, urban centers enjoyed much less appreciation than those farther away did. Now, of course, what does that all mean? And we go back to our usual tools, looking at house price to income ratios, house price to rent ratios, building our, getting our models out of the shelf and running them again. What we did here is for, again, advanced economies, we looked at different models, and you can compare the pre-global financial crisis to the current valuation in this heat map. And actual valuations are stretched much more than, in many of these countries, are much more stretched than they were before the GFC. So there are, of course, this is not true for everybody, but again, the small open economies, Canada, Australia, New Zealand, Sweden, they jump out. And what we do then is think of a asset pricing framework and consider what could happen if interest rates were to increase. And just as a reminder, we did this exercise in March. And we were just thinking, okay, let's look at under different interest rate scenarios and calibrate it to the US data. And this is the red line you see there. If interest rates didn't move from their level in March and continued. And what the model suggested is that this collapse because of this speculative demand, and it goes to a certain point, and once it cannot sustain itself anymore, the bubble bursting in some sense, we would see a decline in prices even if interest rates didn't increase. Then when we considered alternative scenarios of 100 basis point increase or 200 basis point increase in mortgage rates, what the model suggests then is as long as this is gradual, you could see a leveling of house prices than a crash. Now this comes with a lot of caveats. This is our baseline thinking, and you could think of it perhaps as kind of a soft landing case. But it holds a lot of other things constant and primarily focuses on interest rate. And if something else happens, particular to employment and to incomes, then it's a total different ball game. Now, the macro impact, we talked about it a little bit. And again, I do agree with many of the points that were made. This is not GFC. We shouldn't, think about because we lived through a crash ourselves, it's going to happen again. And things are different on the banking side, on the household side. But again, there is some differences across countries. It is true that for many large advanced economies, household debt deleveraging happened, and we didn't see this type of rapid increase. But in small open economies, again, household debts continue to climb during those years, and in some countries, it's double household income, the current levels, and that can be predicted. The other dimension of potential vulnerability is that these numbers are all thinking about the average household, right? So the other exercise that we do is look at the debt service ratios, the gray bars on the right-hand side, and then say, okay, let's see 100 basis point higher interest rate. And by the way, when we're doing the exercise, we thought this was quite, a considerable shock and whatnot. Now we're already there and going faster than that. But what is interesting is that when you compare the yellow dots to the red dots, which is that the red dots are for households, the debt service ratio for households in the most indebted quartile. And in several countries, again, not surprisingly, the small open economies, you would see those households getting quite stretched. And let me wrap this up by just mentioning that in some of these countries, most notably Sweden, we already started seeing actual prices coming down in the monthly series. So it is not a extreme scenario anymore. So everything I went through quite quickly on the exercise itself, of course, but everything that I talked about is in this bulletin that you can find online. And thank you again. And any questions, I'd be happy to take.
Thanks very much, Denise. That was a very good, quick survey of how the BIS viewed valuations in housing markets in a large group of advanced countries. I see that you saw the US sort of in the mid-range in terms of valuations being stretched compared to Canada, Australia, and so on. How often do you sort of update these models? I mean, would you already sort of have an updated view on how the US looks compared to some other markets? I see that New Zealand, for instance, has already seen price declines. That was one of your, I think, cases where you found valuations quite stretched. And since March, since you published this report, I think prices there have declined already quite a bit. So how often do you sort of update this analysis, and do you have an updated view of these valuations that you showed in your slide?
Yeah, actually, we looked at these numbers again yesterday. So considering the lag,
Yep.
these are based on quarterly house price series. So considering that lag, most of these are still as of Q2 this year.
Mhm.
And the monthly information that's coming in, I mentioned Sweden, you raised New Zealand. So we are seeing some of these countries, the red ones, already seeing some correction. But since the models are based on quarterly series, it wouldn't appear in our updates until the fall.
Right. I mean, I should mention that I think it's public knowledge that the IMF also runs kind of a vulnerability exercise on housing markets. And actually, Nina has been in the lead at our end in running those models, but the results of those exercises remain internal. But we also run the kinds of models that Denise has been showing for the BIS. Is that correct, Nina? We don't. Our vulnerability exercise is, it's known that we run it, but the results remain internal. Is that correct?
Yes, the results are internal, correct.
Okay. All right. We have just about 2 or 3 minutes left. I want to go back to each of you and see if you have any closing words, any reactions to what you've heard from other people. Maybe start with you, Mark.
Thank you, Prakash. And I really want to thank you and the fund and everyone for the opportunity to participate. And I learned a lot from the presentations. And I took solace in that we were kind of landing in the same place. But then I thought, well, then we're all going to be wrong. So I wasn't sure that was a good thing or not. I will have to say, and I'll just end by saying this, I do think that the risks here are to the downside, right? Because in a world of very high inflation and central banks on the warpath, and housing being the most rate sensitive sector in the economy generally, we could very well see a much more serious decline in prices that could reverberate back on the real economy to a more significant degree. And that is, I think if it doesn't happen, great, but I think we should be prepared and really think through what that darker scenario would look like, because that I think is something we should not discount. Is significant probability.
And do you at Moody's do sort of similar analyses to what you showed us for the US for many other countries?
We do them for all the countries. So
Okay.
yeah, so we run the same kind of scenario analysis and shock analysis. It depends on how much data is available, obviously, and but for all the countries that there is house price information, housing market information, we do the similar kind of analysis. Yes.
And is most of that public? So I mean, our IMF folks could look it up and compare.
I'd be happy to provide it. We obviously sell it, to financial institutions and to others that are,
Okay.
But absolutely, I would have no. We can talk about that. I have no problem providing that to you, so you can see where we're landing on some of these things.
Yeah, I think that may be of interest to us. So I mean,
Sure.
if Nina can sort of compare notes on
Yeah.
where she's ending up with where you folks are, that would be helpful.
Yeah. You might be interested. The Moody's wide were involved in trying to understand the shift in the credit cycle, and it goes to that question around vulnerabilities, and we're doing this globally. So, where are the global vulnerabilities? Kind of, I'm sure, like what the BIS and the fund do. Looking globally at the balance sheet and saying, hey, where are the vulnerabilities in this kind of environment? And so you might be interested in some of that work as well.
Okay. Julia, any last words?
I found the presentations extremely interesting. I love Denise's international perspective, and the rental yield sort of solidifies what the point Mark was making about the institutional market being here to stay. I concur that as I outlined, there's a rosy correction scenario where actually declining valuations is a good thing.
Right.
For monetary policy and for the economy. There's also, I agree, a scenario where we're still operating based on assumptions of what interest rates look like in the recent past, and that we're in more of a regime change, and there's a harder adjustment ahead, and so I think we all need to kind of continue to think through where those vulnerabilities lie. I mean, as Richard pointed out, the structure of the mortgage market is undergoing a pretty fundamental change, and we don't know what all the ramifications of that are. Okay.
Well, we are right on time, so perhaps this is a good time to end. I want to thank everyone who participated. Nina, Adrian, for your questions. Richard, for moderating with me. Look forward to doing more of this with you in the future.
Yeah.
And thank you, Julia, for coming on and really contributing excellent perspectives. And of course, to you, Mark, again, thanks very much for making the time for this interaction. And we'd really love to follow up with you and have more of a dialogue with our housing experts here at the fund.
Thank you.
Everyone for participating.
Thank you.
Bye-bye. Thank you.
Thank you.
Thanks, Denise. Sorry, I forgot.
No, thank you, Prakash.
Bye.
Bye.
Bye-bye.